We try to be tactical from time to time around the market, but the big picture is still intact. We see several years of what's likely to be good economic growth and continued upside on equities.
Pretty wimpy year-end target, David, still. Not much happening between now and the end of the year, right? What is that, 2%?
Yeah, don't forget about the dividend yield.
Yeah, I'm trying to get it back. No, but he's at 2% for the rest. That's all we get between now and December is 2%?
Look, I would tell you that there probably is some upside to our earnings estimates, and as long as interest rates don't jump from here, there's room for PE expansion.
What's jump? Is that above 3.2%?
We're very comfortable with an 18 trailing PE, provided the 10-year Treasury yield doesn't go above 3.5%. And there's not a hard breaking point. I mean, don't forget, there's the PE, which is connected to interest rates, and then there's the earnings. So we have to keep an eye on what the earnings are doing. But right this moment, I think investors are feeling a little bit more calm about the risk of a trade war. They're seeing, I think, the messages, and Becky, I think you nailed it on the head. President Trump's not going to back down, but President Trump does negotiate. And I think that's what we're all beginning to realize. This is somewhat connected to NAFTA and ongoing trade negotiations. And a lot of these negotiations agreements do need to be revisited, but hopefully in a constructive way that promotes growth.
Could we go above 27.50 and then come back down, or?
Right this moment, we are tactically bullish as well as strategically bullish.
2% is not tactically bullish.
We believe
you're not selling, but you're not really.
18 times trailing.
I'll define that for you. We believe the next move on the S&P is more likely to be up 5% plus than down 5% plus.
All right. Well, that's more than 2%.
Yes. So we do believe that the S&P can be above our 2750 target probably this spring. And we'll keep an eye on the earnings and interest rates.
A weird target. It's just like
targeting for the end of the year.
Right. It's kind of like a valuation.
It's our fair value.
It's like a fair value for what the S&P is worth. All right. I hope you're going to tell us something, Rob, because I'm, no, it's good. Let's talk underlying economy. We at 2.5 right now. Can we count on that for GDP?
Yeah, look, the underlying economy looks really solid right now.
What about the trade war?
If there's a true trade war, that's a problem. But remember what we're talking about here. We're talking about tariffs, and everybody gets worked up when you put a tariff on here, a tariff on there. Tariffs are taxes. Right? And so in the same sense that we don't panic when a state changes its retail sales tax, we shouldn't panic necessarily over tariffs. If it keeps blowing up and they retaliate, then we retaliate, and you get a shooting trade war on your hands, that's going to be very negative for growth. Our estimate that the steel and aluminum tariffs have put on in the 25% and 10% form is less than a tenth. Far less than a tenth on GDP growth. It's a tiny rounding error in inflation. It's simply too small part of the aggregate economy. So we still think we're shooting for 3% this year, 2.9% for 2018. Be forewarned, Joe, that Q1 is going to be a weak quarter once again.
Always.
We're tracking 1.6. That doesn't change, though, our 2.9. For the end of this year. We think we see a lot of rotation into investment, an ongoing energy story, and always the households are there for us.
So I was going to say, what are the stakes for Friday's jobs number here at this point in terms of, are we going to see the kind of eye-catching wage gain, or is it?
So I don't think so. I think that the eye-catching wage gain that we saw in last month's report was more or less an error driven by exceptional number of sick days and snow days in the month. Basically, you take out hours worked and you get the same pay. It looks like a big bump in salary. So I think wages go back to normal. That said, we've got a lot of activity coming on board this year. We see wages finally breaking out of that 2.5% range that they've set in for 5 years and creeping up, to that momentum. 3% by the end of this year and into next.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.